All right, we're going to go ahead and get started. It's good to see everybody. So I have a question. First question of the day. How many people ended up testing positive for that crazy COVID over the Christmas holiday?
I haven't tested, that's how.
1, 2, 3, 4. I know 5. So it's crazy. Oh my gosh. You know, your wife did? Yeah. Yeah, hey, the most difficult part about it, I think, is trying to find a place to get tested. You know, craziness. Well, anyway, last week was a very interesting week in our business. And I say our business, real estate and lending. And the reason why is because of what took place over the last now 7 days in terms of interest rates. So let's take a moment and talk about that. So over the weekend, I got a call from 2 people from this office, and they were working with clients, and they said to me, Greg, now please, it's okay. They ended up, they were using somebody else. But, and that's okay. That's fine. I get it. And they said, but they were, they thought their interest rate was going to be around 3.25%. And over the weekend, when they were writing contracts, the lender told them the rate's going to be 3.75. Greg, can you help them? And I said, I'm going to answer that 2 ways. Yes, I can help them. No, if they want a better rate, I'm sorry. Interest rates have gone up that much. Now, here's what happened. The Treasury Department, back in, or as you and I hear them talk about, the Fed has been talking about raising short-term interest rates, and now they've put that in, they're saying they're definitely going to be doing that. But the second thing that affects you and I is they said they're going to stop putting money into treasuries, and they're going to start phasing out how much they buy in treasuries. In April of 2020, after COVID hit, and the treasury market went absolutely bananas, the Fed stepped in and said, we will buy the mortgage-backed securities. And they started buying billions of dollars of mortgage-backed securities, which dropped our interest rates, and it dropped them substantially. And it kept everything moving, which then got real estate going, got refinancing going, kept the economy going through a very difficult time when COVID was just getting started. And so, the Fed now has said they are going to start phasing out of that commitment. They're not just going to cut it off, they're going to phase out. Well, they've started that phase out. They've also said we are going to be committed to raising short-term rates, which normally doesn't affect us, but it is now because of the impact it's having on the overall, potentially on the overall economy. As a result of all of that, the 10-year Treasury note, which is what the trend that we follow on mortgage interest rates, has risen to its highest point since January of 2020 in 1 week. Biggest single increase we've had in over 2 years. So as a result of that, if you had lenders like me and others talking about, well, gee whiz, we had rates 3 1/8, 3 1/4, 3 3/8, those are gone, at least for now. The Treasury note has gone way up. The yield on the Treasury note's gone way, way up. Casey?
What's par on interest rates right now?
Casey's asking, what's par on interest rates? Well, par on interest rates depends on a whole bunch of factors. If it's conventional, FHA, VA, what the credit scores are going to be, blah, blah, blah. Let me give you a couple of examples. If you've got high credit scores, over 760, you're getting a conventional loan, you're probably looking at an interest rate somewhere between, and I haven't looked today because the Treasury note was going up, they cut off rates and they're raising the rates again, so you're probably looking at about 3.75 today. Now, over the weekend, I have an FHA customer. FHA is usually a little bit better than conventional with decent rates. So over the weekend, I had somebody with a 653 credit score, getting an FHA loan, everything else is fine in the loan, and I quoted them 4.125. That was the rate. Today, it might even be a little bit higher than that. So the par rate, Casey's hard to say because of the credit score difference, but I can tell you this, a starting point is probably somewhere around 3.75 and up from there. Yes?
So the news has been advertising that interest rates by the end of the year were like 10 days ago, they were advertising that interest rates were predicted by the end of the year to be like somewhere in the range of 3.85 to 4. Are we now kind of considering that interest rates might be above 4 by the end of the year or early next quarter?
Casey, that's a great question. He's asking, last week they were talking about interest rates being 3.75 to 4. Are they now saying it's going to go over 4? Personally, I think it's going to stay in this category, somewhere between 3.625 and 4.125 is the general category. I don't think it's going to move too much from there. Now, I could be wrong, but I think that's where it's going to stay. I just don't see it moving substantially from that. But what I want to talk about this morning, so now you know a little bit about the fact, number one, rates have gone up. Number two, you got a little bit of information as to why rates have gone up. Now let's talk about what impact it has. And the first impact is the note that I sent out last week in Friday's Finest and on Thursday before that is if you're working with a buyer or if you have a listing where somebody's brought you a pre-approval that was from a few weeks ago, you have now got a responsibility as a real estate agent to make absolutely sure those people still qualify. When I was doing pre-approvals back in December, most of those pre-approvals we were putting, and I would calculate the numbers, I'd be calculating somewhere between 3.25 to 3.5. I always try to bump it up a little bit just to be safe. So if I put in 3.5 and the rate's 3.25, everybody's happy. What I don't want to do is put in 3.25 and have the rate go to 3.5, now they don't qualify. So we always bumped it up a little bit. But a lot of lenders don't do that. Someone called me this morning and their lender put in fact, an agent from this office, their agent at their company, Rocket Mortgage, gave them a pre-approval back in around Christmas time for 3.125. She said, do you think they're going to still have that? I said, there's not a chance in the world. She said, well, I don't know if she was going to qualify now. And I said, that's the point I'm trying to make. Whatever you had back in December, get with the lender, whether it's me or somebody else, and ask, does that still apply today to make sure their debt to income ratios qualify? Here's the impact. I made some notes. Let's just take a $300,000 loan at 3.25 versus 3.75. What's the impact on a $300,000 loan? It's 6%. Meaning the principal and interest payment is going to go from $1,357 to $1,436. That's a 6% increase. Now, if somebody's got tight debt to income ratios, that could push them outside of what they can afford. If you're representing the seller, think about how important this is. If you're representing the seller and somebody has not locked into their interest rate, if somebody's not locked into their interest rate yet, and you think they're closing at the end of this month, and that when they went under contract at the end of December or the first, beginning of January, and they're not locked in yet, if I were the listing agent, I'm on the phone with that buyer's agent saying, what's the status of the lock-in? Because what happens if they try to go lock in today and the interest rate went from 3.25 to 3.875? They might not qualify. Now all of a sudden, what do? And it doesn't make any difference what the financing contingency is because you've had your house off the market, your seller's house off the market for 1 or 2 weeks, only to find out that now the buyer can't close. So there's a responsibility that you and I carry to make sure that our seller is protected. Just like I'm making sure that the buyer can still buy the house that they put a contract on. And so it's okay for you as the listing agent or the buyer's agent to call up that crazy lender, me or whoever, and say, have they locked in? Because if they haven't, and if their ratios are tight, there could be an issue. Now, before I go on, questions on that piece.
I can't remember, Can you do the three different rates for 300 at 3.125 and 3.75? What were the payments?
Oh, 3.25 on a $300,000 loan, principal and interest is $1,357. At 3.75, it's $1,436. Now let's look at the impact of that on buyers that you're working with. So the buyer says, my goal is to have a payment of X. And so you and I give them a number that they can work with. You start showing them homes at that price, knowing that because now we're going to meet their target number. And all of a sudden, interest rates have now gone up 0.5%. Well, what impact does that have? Now all of a sudden, their monthly payment is going to go above their threshold, or they're going to have to buy less house. Now, you tell me, if you're showing somebody homes for $330,000 and all of a sudden, now they can't meet their monthly payment goal, so now you have to show them homes at $310,000 or $305,000. Is there a difference in the quality of that house?
Yes.
Significant. How happy is your buyer going to be? Not very happy. So we have to prepare the people that you're going to be showing homes to, or that you are showing homes to, that have set numbers that they're expecting for their monthly payment based on the home that they thought they could buy in November or December. Now they're going out and realizing, wait a minute, once if I buy that home for $330,000, I'm going to have to pay 6, 7, 8% more than I did when I originally got pre-approved. And like the one gentleman said to me yesterday on the phone, he said, well then Greg, what good is a pre-approval? And I said, slow down a moment. I said, pre-approval does not guarantee your interest rate. I wish it did, but it doesn't guarantee your interest rate. He says, yeah, I know, I'm just having some fun with you. But he was not happy. I mean, I've been working with him since August, back when we had rates he's got 800 credit scores, so he's putting down a fair amount of money. We were flirting with 2.875, and now I'm telling him he's going to be 3.625 to 3.75. So he's not real happy about it. But that's the reality of what we're dealing with. So this morning, I'm sitting at my desk and at home before I come in here, and I'm looking at what's going on, and all of a sudden a flash comes across from our secondary department and says we have frozen rates. A decline in the market is causing us to have to worsen pricing. We'll let you know as soon as pricing opens back up. So I right away looked at the T-bill, and the T-bill had shot way up this morning. It's come back down a little bit. Now it's going back up again. So that simply says to me is that today is probably not going to be a day that we're going to see an improvement in the rates. Now, maybe we'll see an improvement tomorrow, maybe Wednesday. God forbid we have a week like we did last week, because that was no fun. That was no fun. All right, questions. So let's do a quick recap. Number one, we talked about the fact that rates have gone up, so we all know that now. That's important that we communicate that to people. Not about being negative, it's just about being reality. This is what's going on. You now have an idea as to why that has happened. All right, it's the Fed. It's not mortgage companies, it's not you, it's just the Fed. Number three, the impact that it could potentially have on a buyer or a seller, and why it's important that you and I communicate that information. Number four, you also have an idea now on, it's about a half a point's about 6% in both buying power as well as the amount that person's going to have to stomach if they're going to still buy at the same price. They're going to pay 6% more on a monthly basis forever until rates come back down, and now they can get a little, maybe refinance. Now think about this for a minute. Prior to January, for about 6 or 7, 8 months, there was a lot of talk and you heard it because many of you would say something to me about it. You heard it from people, well, I'm just going to wait till the market cools down a little bit. I'm just going to wait. Market's going to cool down. People are going to get more real, and we're just going to, and I'll just buy then. Now, Think about all those people and what they're doing today. Pricing has not gone down. This is no joke, I had 5 new pre-approvals go through this weekend that were writing contracts. 5. Only 2 contracts were won by our customers. 3 of them got outbid or went to somebody else. That's only 2 of 5, which means I say that the market has not slowed down, which simply says pricing is still moving up. That says 2 things to our buyers. Number 1, it says, well, you're paying more because interest rates have gone up. So whatever you thought about back in August, September, and October, goodbye. And you've waited thinking pricing is going to come down, and pricing hasn't come down. Now, last week, Wednesday, Mike said something very significant in here. Mike said, when interest rates go up, people take action. They don't go sit on the fence, they take action. And that's exactly what happened last week. The fence sitters started hearing that interest rates were going up. That creates fear. It creates the emotion of fear. There is no greater emotion to move us to action than fear. That's just human nature. That was in Friday's Finest last week. Because of that, there's more people trying to take action today than there were just 3 weeks ago. So as a result of that, the buyer market is getting slightly bigger, and the seller market, you already know, there's not enough homes. So pricing's not going down, at least not what I'm seeing. Now maybe it's going from 11 or 12 days on the market to 13 days on the market or 14 days on the market. So what? Rip was telling me he had somebody, I think it was Rip, somebody $900,000 cash offer on a house. Somebody was just telling me that this morning. Casey was telling me $900,000 cash offer on a house. Gosh, I mean, it's not slowing down, which simply says if there's ever been a time to buy, that time is right now, because it's not going to slow down. It's just not. Questions? Comments? Tom?
What's the best place for us to go to track rates? Is it on your website? Or?
No. I don't publish anything on rates on the website because people would take that as that's what their rate is, and that has nothing to do with it. The way that I track rates is simply to go to Market Watch, and I just look at the 10-year Treasury note. Now that doesn't give you the interest rates, that gives you the trend of where interest rates are going to go. If the yield on the 10-year Treasury note is going up, that means interest rates are going up. If the yield is going down, that means that interest rates are probably going to get softening. That's how I look at it. I mean, that's just what it is. And then, of course, you can call me and say, Greg, like Casey said, what's the par rate? And I'll always give you my nebulous answer. Well, it depends on all that. I don't mean to be mean or I'm not trying to be evasive. It's just too many factors in place to tell you. Yes, Casey.
No, I'm going to table that question.
All right. Any other questions or comments? All right. We're going to have the session next week is going to cover how do you combat some of this and what can you do to improve your chances with the listing agent when you're putting in a contract. What are the things that you can put in there? And one of the things that happened this past week with the 2 that did go through, both agents I know, in fact all 5, but 3 of them are really strong. They asked me, Greg, how soon can we close in case the seller wants to close quickly? And I said, if you give me a contract over the weekend, we'll close it by the end of the month. And the 2 that did come in are both closing at the end of the month. Obviously, my team is looking at me like, Greg, are you crazy? Come on now. It's Monday morning. 31st is 21 days away. And I said, it's okay. We're fine. We can get them done. So, but there's other tools that you can put in your little quiver to make your offer look the best. And we're going to talk about that next week. Jeff.
On a kind of a different subject, are you seeing more, less, or about the same in property inspection waivers?
About property what?
PIWs.
PIW, probably about the same. PIW, Jeff is talking about, stands for something called a property inspection waiver. When a lender runs the loan through Fannie Mae, Freddie Mac's automated underwriting system, as long as they're putting down about 20% or more, we'll receive something called a PIW, property inspection waiver, which simply means, in layman's terms, no appraisal needed. And Jeff, we're seeing about the same amount. Nothing, not more, not less. Credit score driven, loan to value driven, those are the things that are going to tell us whether or not we get a property inspection waiver or no appraisal needed.
How about appraisals? How are they coming?
Appraisals seem to be coming pretty good, and I really think that's because of all of you. I think it's because of the agents. Agents on these seem to me to be so attuned now with what's going on in the marketplace. They're pretty much telling me when the contract comes in whether or not the appraisal is going to make it or not, or it's going to be close, something of that nature. So I think appraisals are coming in where we need them to, or where the agents are saying that they'll probably come in at, mainly because you have a real good handle for the most part on where things should be. Anything else? All right, thanks everybody, appreciate it.